Welcome back, everyone, to another explainer. Look, I am absolutely thrilled you're here today because we are diving headfirst into one of the most fascinating, kind of mind-bending financial puzzles out there in the market right now. We're talking about Cipher Digital, ticker symbol CIFR. This company is currently sitting at a massive $6.9 billion market cap, but it presents a total paradox when you actually look under the hood at its financial data. It's really a masterclass in just how complex and honestly contradictory market valuations can be. So get ready to focus in because we're going to untangle this whole mystery together. Right off the bat, let me just ask you this. Can a company lose $800 million and still be an absolute market darling? I mean, conventional wisdom tells us that investors heavily punish unprofitability, right? Especially at that extreme scale. But as we're about to see, Cipher Digital is completely defying gravity here. And really, that's our central mystery for this explainer. Just check out this contrast. Over a trailing 12-month period, shareholders saw a massive total return of over 520%. I mean, that is explosive, literal life-changing growth. Yet, over that exact same period, the company's net income was a staggering negative $822 million. Both of these massive numbers exist at the exact same time. We've got a stock that's practically minting money for its traders on one side, while the underlying business is just hemorrhaging cash on the other. Okay, so to untangle this, here's our roadmap. First, we'll look at the explosive market performance. Second, the profitability problem. Third, debt and liquidity. And fourth, a valuation reality check. Let's get into it. Starting with part one, explosive market performance. This is the bull case. If you want to know what financial whiplash feels like, just look at CFI's yearly performance. Back in 2022, the stock lost nearly its entire value, tanking almost 88%. But then we see this violent shift. 2023 saw it rocket up nearly 638%, and 2025 posted another massive 218% gain. Investors are riding these wild triple-digit percentage swings. If you caught the timing right, the rewards have obviously been astronomical. Now, you might be thinking this is all just blind hype, but it's not. The bulls are excited by some actual blistering top-line growth here. Their 3-year compound annual growth rate for revenue is an unbelievable 318%. And with trailing 12-month revenue sitting at nearly $224 million, they are undeniably scaling operations. They are bringing real, actual money in the front door at a super rapid pace. Which brings us to part two, the profitability problem. Let's look at the bear case. So what's really interesting here is this return on equity of negative 102%. Let's break that down for a second. Return on equity measures how efficiently a company generates profits from the money shareholders have invested, right? Well, at negative 102%, for every single dollar of equity, the company is losing slightly more than $1. It's a pretty stunning display of wealth destruction at the operational level. And the core of the problem really lies right here in the margins. Their gross profit margin is actually quite healthy at 61%, which tells us their core product or service is actually highly profitable to produce. But then the net profit margin plummets to negative 121%. Basically, once you factor in overhead, capital costs, and operating expenses, they bleed through every single cent of that gross profit, and then they just keep bleeding. It's like they're filling a bucket that has a massive hole in the bottom. And the result of those collapsing margins? A staggering negative $734.7 million in trailing 12-month free cash flow. Free cash flow is, of course, the actual cash a company generates after maintaining its operations and capital assets. So burning through almost $750 million in pure cash in a single year, that really highlights the sheer scale of the financial hole Cipher Digital is digging right now. Okay, moving on to part three, debt and liquidity. Basically, how are they staying afloat? You're probably wondering how they even keep the lights on with numbers like that. Well, the first clue is the current ratio. Let's just jargon bust this quickly. It simply measures a company's ability to pay off short-term obligations with short-term assets. As a rule of thumb, anything over 1 is generally safe. CFR sits at a very comfortable 3.79. So despite the massive overall losses, they actually have plenty of immediate liquidity. They aren't going bankrupt tomorrow, for sure. But, and this is crucial, maintaining that short-term liquidity comes at a very steep price. Look at this. Over a 3-year average, their debt-to-equity ratio was a really conservative 0.41. Today, that ratio has exploded to 3.42. That is a 724% increase in their reliance on debt. Basically, to fund that massive cash burn we just talked about, they are aggressively leveraging the company. And that leads us to our final section, Part 4, Valuation Reality Check. Let's see how the market is pricing the hype. Real quick before we look at the data table, I want to anchor this specific metric for us, the EV to sales ratio, or enterprise value to sales. This simply tells us how much it costs to buy the entire company, including its debt, relative to the revenue it actually generates. It's essentially showing us how much investors are willing to pay per single dollar of sales. Keep that in the back of your mind because the numbers are about to get pretty intense.
All right, here we go. Across the board, the price of admission to this stock is wildly expensive right now. The price-to-sales ratio sits at 31, which is up almost 62% from its historical average. And that EV to sales metric we literally just defined, it's approaching 40. Investors are paying almost $40 for every single dollar of revenue. And even more shocking, the EV to EBITDA is at an astronomical 249. The market is pricing in an absolutely flawless, perfect future for a company that is currently losing hundreds of millions today.
So let's pull all these clues together. Here is the CIFR paradox laid completely bare. We've got a company commanding a massive $6.9 billion market cap, totally backed by this undeniable blistering 318% revenue growth. Yet, simultaneously, it's posting $822 million in net losses, burning through cash, and bridging that gap with a surging mountain of debt. Which leaves us with the ultimate question, the one that you now have the data to answer for yourself. Is Cipher's Digital a true visionary growth play, spending heavily right now to capture a massive future market? Or is this just a heavily leveraged valuation bubble that is mathematically destined to burst? I'll leave that up to you to decide. Thanks so much for joining me on this explainer. It's been a fun one. See you next time.